Here we have the app, and basically it's a fundraising app designed for you to raise the first money for your company. We call it a cyber app because it involves combining traditional legal contracts with autonomous technologies, with smart contracts, with crypto, with blockchain, right? That makes it more efficient. That makes it just better overall in many ways, as you'll see. So we go here, we start a fundraise, and this would be if you're the founder of the company and you're raising money, right? That's kind of the view that you have here, right? And what you're immediately going to see is how do you want to raise your capital, right? And you can pick a round type. Now, we have all these round types here. We have pre-seed, we have seed, we have Series A, Series B, Series D. Realistically, based on the types of agreements we have here, almost certainly you're going to be in pre-seed or seed. Maybe some people do a Series D with a SAFT or a SAFE or something as like a bridge. It's possible, but would be pretty unusual. The reason why we have these here is just because of that slim possibility, and also that we do plan to build full on share sale capabilities, like NVCA style rounds that would be more appropriate to a later stage fundraise. But in the meantime, and that's why we say recommended, a lot of times this is going to be for your first money round, could be raising from friends and family, could be raising from angels, and could be raising from some, early stage VCs or from an incubator or accelerator or something like that. All of those are on the table, either a pre-seed or seed. And what you see here are a litany of traditional, what I call convertibles. These are early stage fundraising instruments like the simple agreement for future equity from Y Combinator, like the simple agreement for future tokens, like a token warrant, like simple agreement for future tokens and or equity, right? Probably the only type of convertible that we don't currently have represented on here that is still used sometimes would be a convertible note, right? Prior to the safe becoming dominant, convertible notes were a very dominant early stage fundraising tool, particularly at the pre-seed stage. But the safe really kind of supplanted that. Some people still like the convertible, but ultimately it's not used very much, and I consider it's pretty old-fashioned and nonsensical when safes are around. But hey, if someone wants a convertible note, guess what? We have a custom field, and we'll make you a convertible note. Okay, just hit me up, or if you want, any type of different document, we can make that custom, right? And then we'll give you a little template ID, and we'll set you up. But for now, what I'm going to do is I'm actually going to do this as a safe plus a token warrant round, and I'm going to do that at pre-seed. And you're going to get a nice little explanation here of what a safe and a token warrant is. And also, what you'll notice here is that there are two variations, right? One is a Reg D version of this, and one is a Reg S. Why are there two versions? Well, you need to study your United States securities laws, because under United States securities laws, every offering of securities has to be either registered with the SEC or exempt from the registration requirement. Generally speaking, you don't want to be registered. That's a very, very expensive process. That basically means you're IPOing, which typically only very mature companies do. Apple is registered, Microsoft is registered, Google is registered, Coinbase is registered. You don't want to register as a first-time founder, right? So you need one of those exemptions. And what are the popular exemptions? Well, the most popular for an issuer, that is you, that is the founder of your company, are Regulation D and Regulation S. Regulation D, it's a version of doing a so-called private offering, a private round. But the word private has some nuanced meaning, as you might expect. And what it ultimately typically ends up meaning in practice is that you're only offering and selling to accredited investors. Sometimes you may be doing that very privately, and that may lead to certain benefits. Sometimes you may be doing the offer publicly, but it's still an offer only to accredited investors, and you only sell to accredited investors. That's the typical path for Reg D. There's some exceptions to that, like technically under Rule 506B of Reg D, you can sell to up to 35 non-accredited investors. There's certain conditions around that. It's very impracticable, and almost no one does that route. But be that as it may, it exists as a possible option, right? And then there's Regulation S. And Regulation S basically means that you are neither offering the security to nor selling it to US persons, right? And US persons has a certain specific definition that if you're cutting it close or if you are in any doubt, you'd want to look at those definitions carefully or talk to an attorney. Maybe your attorney is ChatGPT, maybe your attorney is an actual attorney, but you would want to give it some thought, right? So that's the approach. Now, it doesn't matter what jurisdiction your entity is incorporated in, right? I'm assuming at that point that you have this point that you already have a business entity. We will offer a separate app for forming a business entity if you already have one. Let's just assume you've already formed a corporation, you've already formed a company somewhere. Maybe it's in BVI, maybe it's in Wyoming, maybe it's in Delaware, maybe it's in Switzerland. It doesn't matter. It doesn't matter where it is, right? Where your company is does not determine what your compliance strategy is. A US company can do a Reg S offering. A non-US company can do a Reg D offering. It really depends on what mix of buyers you're selling your security to, right? Not where you are incorporated. So where you're incorporated can affect certain details under Regulation S, like how long before the security can be freely traded in such a manner that Americans might end up buying it and things like that. Typically, as an early stage company, you're not going to get into all that. You don't want your securities being liquid, right? So you're just going to be prohibiting that across the board for at least a year, probably much longer, right? So anyway, so what we're going to do this as a safe plus token warrant under Regulation D, right? And you'll see here that it explains the safe is the Y Combinator simple agreement for future equity, adapted with some changes that we made so this can work with smart contracts, but we tried to keep the changes very, very minimal because Y Combinator is a market standard, so we didn't really change the substantive terms of it, the economic terms, the formulas. All of these things are the same as the standard Y Combinator safe, and you should want that because honestly, it's a fair deal. It's a standard deal. And then we have a token warrant, and the token warrant is based on A16Z standard token warrant. Again, we try to keep the changes there very minimal, just for the purpose of making it work with our app. There are a few more changes with that one because A16Z has some provisions in its token warrant that are specific to giving rights to A16Z. So we did remove those because A16Z might not be in your round if you are doing this, right? But other than that, it's very similar to the A16Z token warrant. And this explains its Regulation D. It gives some links to learn more about those things. Of course, if you're really completely ignorant about those things, you can DM me about them. You can DM another attorney about them and get actual legal advice about them. But there's some information here. So next up is we set this up, right? And the way that this works is there are contracts on one side, on the right-hand side, and there are fields to fill out on the left-hand side. And there's all kinds of nice little, you can go back to the explainer over here. You can go to tooltips to see what each field means. You can read through the document. Okay, all these things are available to you. All of these documents are on IPFS, so it's verifiable exactly what you're signing and that it's the right thing to be signing. We have version control for these different templates because of course there's going to be changes to these things over time and people are going to want to track that and all that sort of thing, right? But what you basically have, let's just talk about the legal documents first. You have, first of all, a cybersecurities purchase agreement, right? And that is an agreement that says the issuer, that's, typically the startup company, right? You, the founder, the thing you control, your project, is selling some securities to a buyer, which is an investor, right? For money, right? Typically you just have a safe, and the safe is also a purchase agreement for itself. But the old school way of selling securities is you have a purchase agreement on the one hand, and then you have an instrument that's being sold on the other hand. We went back to that old school methodology for this, ironically, because it's all cyber. But the reason we did that is because you're buying this on chain on our app, there's some special mechanics above and beyond the normal that we have to take pains to spell out here in this purchase agreement. I didn't want to litter up the standard safe with all these things about smart contracts, to a massive extent. All these adoption procedures and explaining what it is to sign an agreement when you do it on a blockchain and spelling out all these variables. I wanted to keep that and these definitions of what is a blockchain and where are these certain smart contracts and all this sort of thing. I wanted to keep that to a minimum within the securities themselves. So that's why it's broken out into this separate cybersecurities purchase agreement. You also see that this is labeled here simultaneous sign close. That means that this deal is going to close when the investor signs it, right? The company, the founder is the first one to sign it. Then the investor comes and they sign it, and they're going to be paying at the exact same time as they sign. Many deals in the world are, especially sophisticated deals, high dollar value deals, are what's called deferred sign closing deals. Closing is what's deferred. The type of deferred closing most people are familiar with is real estate, right? Because with real estate, first you sign the purchase contract. Then that contract explains that there's going to be an inspection. There's going to be a certain amount of time you have to do the inspection. There's going to be a process of obtaining the title insurance, and that's going to take some time. There's going to be money put in escrow, right? There's going to be, all these things, and everyone needs to take these steps before the person actually buys the real estate and becomes the owner. For this, there's nothing that really needs to be done, right? I mean, that's the nice thing about early stage deals. There's no legal opinions that are getting delivered. One investor, they're just investing their money. They're not conditioning their investment on whether other investors also invest their money. They're not setting that I only want to invest if you're raising at least 2.5 million. And if you're not raising that much, then I don't want to invest. None of these things exist in very early stage fundraising deals. There are no closing conditions. There's nothing you have to wait for. And so that's why it's a simultaneous sign close deal, just so you know. I realize it's an academic point, but that's why. And we may at some point, almost certainly will, serve deferred closing deals as well, but they're going to be more complicated deals, of course. So now you scroll down, and just one of the things I would point out about this purchase agreement is that you're going to see a lot of yellow variables. What are these yellow variables? These are actually pointing to certain smart contracts on Ethereum. Ethereum is the blockchain we're picking here. There are different options. They're pointing to specific smart contracts on Ethereum that store and manage key logic and data for the deal. Maybe I'll do a separate video at some point, really walking through all of this in great granular detail. But the bottom line is, as you're filling in information here on this left-hand side, that is supplying values for certain of the variables that are listed here. So that when you combine those values with this legal document, that is what the actual deal is. That is what the actual agreement is the combination of those things. That is why we call it cyber. That is why we call it a cyber safe or a cyber corp or a cyberRaise or what have you. It's because we are using smart contracts to manage this deal and to parameterize this deal so that it's a real custom agreement between two parties rather than this which is just a pure template, right? It's not a customized deal, it's a template. So that's what this is all about. And a lot of attorneys would probably just try to finesse these details in certain ways. They would probably just write a defined term, the deal management smart contracts, and they would define it as the deal smart contracts managing this deal on Ethereum or something like that, right? That's actually a circular definition. I'm very particular about the way I do these things. I don't like any circularity. I don't like any vagueness. If any of this were to ever go to court, I I want it to be possible that the judge or the jury or any attorneys or anyone involved in that case no matter how stupid they are, no matter how little they might know about blockchain or crypto, that if the party hires an expert witness for crypto, that that crypto expert can systematically walk them through the document and explain precisely what every single clause is, right? With hard data, with really, I mean, whenever you get into words, of course, there's always some possibility of ambiguity or dispute, but there's levels to that game, and my level is extremely high. I used to do multi-billion dollar mergers and acquisitions deals, where you might expect people care a lot about precision and there's a lot riding on it. And I've never lost that ethos, and I've applied that ethos into this. So that is why, some people might say, why all this excruciating detail? Why don't you use certain shorthands? It's harder to understand this way. Look, I think ultimately you don't really need to understand it. I mean, you need to get the gist of it, but who really needs to understand it is when there's a dispute and there's experts giving testimony in court, right? And I am catering to that audience ultimately, right? Because I know, for the other audience, it can always be distilled down into simpler, plain language terms. You can give summaries, or you could speak more plainly, or whatever. But when those experts come in, and they are predators, and they are trying to pick words apart and make them seem ambiguous or twist things, I want it to be as precise and clear a deal as I can possibly make it. And that is why I literally am cross-referencing the data structures inside of the smart contract that is being used to manage the deal within the agreement itself. And what I call that approach is qualified code deference. I coined that term. You can actually go, there are academic articles written about that term because I invented it years ago. So already people have written articles about it. Professors have written articles about it. Drew Hinkes, a good friend of mine, a fellow crypto lawyer, he wrote an article about it. So forgive me if that is boring, but I wanted to explain it. So now you scroll down and you see here on the exhibit, these are the securities being sold pursuant to our cybersecurities purchase agreement. These are the securities being purchased, I should say, rather. Well, if one person's purchasing them, another person's selling them, of course. And it's in this case, it's a simple agreement for future equity, and it's a warrant to purchase tokens. The SAFE, the simple agreement for future equity, that's here. Now that does also have some details. The reason for this, the reason why there's some smart contract terms here is that unlike a normal safe, we are going to issue this safe to the investor as a certificated security represented as a non-fungible token. Okay. So when this deal closes, when the investor pays for the deal, when they make their investment, they are going to receive to their wallet an NFT styled as a certificate representing this safe. So just you've heard of stock certificates, it's like that, right? And I want to make very clear in this agreement that the agreement is going to be represented by a certificate and the information that will be in that certificate. You're going to be able to go, and I'll show it in this video, you're going to be able to go on Etherscan and you're going to be able to click on that NFT in your wallet, or the investor is going to be able to do so. And they are going to be able to pull up an image, and the image is going to look like a traditional or a somewhat traditional security certificate with their name on it, with the dollar amount of the safe on it, and the company's name on it, and so on, right? What that means is, in theory, I mean, initially it's going to be non-transferable, but in time, and subject to applicable law, there's holding periods, blah blah blah, people can trade these digital certificates, right? Or people can pledge these digital certificates into credit protocols and use them to take loans against, right? Things like this. So what actually is a safe, right? It's a convertible security. What does it convert into? In most cases, it converts into actual shares of stock of the company, of the startup, right? And it does that when they do their first priced share sale round, right? In here it's called an equity financing. The conversion is based on formulas. Most typically, it's going to be the dollar amount that they paid for the safe divided by what's called the safe price. And the safe price, it's basically the valuation cap, the valuation of this round, in effect, divided by the company's fully diluted capital stock, the number of shares that it has as of the financing, right? So if you have this information all on chain, right? Like if the company's cap table is also on chain and all of its safes are on chain, then you get to a point where it's like, okay, well, you want to make it a convertible. You can literally convert this token into another token, right? So 1 second, the NFT represents a simple agreement for future equity. We press a button and boom, the metadata will be changed. And now it suddenly represents a certain number of shares of stock, right? And we will be able to calculate all that algorithmically. And so just based on, all the information about this company that we have by virtue of the fact that its capital structure and all these other things are on chain, right? Um, so this is the future. This is how it should be, right? Rather than when the conversion event happened, I got to go back, I got to read this thing, I got to go through the spreadsheet, look at these shares. No, there would be no need at that point for anyone to go back and read anything or understand anything, for any lawyers to get involved, because all of the logic of how this conversion is supposed to work is very mathematical. It's actually completely deterministic. All that has to be the case is that data is in the right place and that we use Ethereum where we have these programmable assets, right? I mean, that's what Ethereum's good at, right? You can program them to do this conversion. And why do this, right? Why? I mean, there are many reasons to do this. One is simply efficiency, right? It's just more efficient, right? You don't have to go back and read things. We already embedded the rules on the day that we signed this, and it doesn't have to be revisited again. We don't need to remember it. We don't need to get lawyers to remember it, etc. That's certainly one convenience of this. But the more important convenience over time, I would say, is from a trust perspective, right? Because I mean, I angel invest in things. And then I've also, as a lawyer for many, many companies over 15 years of practicing law, I've seen many, many situations. And the reality is, there are what we call principal agent problems in corporate finance, right? Someone invests and then they don't, it's not like they have real-time information about the company that they invested in typically, right? If it's an early stage company. And so there's a lot of trust there. You're trusting the company that when they do their Series A round, that they come and tell you, right? And they give you the new shares, right? They give you the new securities they're supposed to have. You're trusting their lawyers to do the math right, even if they have all the most honest intentions in the world, they could mess up the math, right? You're just trusting a lot of things, right? It does not even have to be something nefarious. People just forget about things. I literally have seen a situation like this where the safe was saved under the name of a different client and people forgot about it because it wasn't in the right fucking folder. And so no one knew that this safe was outstanding and this person was supposed to get their shares. These things happen constantly. Okay. And so there is trust. And what you can do with something like this, if it's all just programmatically guaranteed to happen under the right circumstances, is guess what? You don't have to trust that anymore. You just can rely that that's going to happen. Most likely. I mean, everything is still probabilistic, of course. I mean, Ethereum could have some crazy fork and they could brick the smart contract, or God only knows, right? But you're getting into much smaller probabilities than some idiot first year associate dropping a file in the wrong folder, which, to be quite honest, is not a small probability. I mean, I hate to say that, but it's really not that small of a probability. Whereas, Ethereum bricking smart contracts through an upgrade, I would say, is a very small probability at this point. Anyway, so that's part of the benefit of all this, is the programmability of why you even want people to have these tokenized certificates. And as we get more and more companies on MetaLeX, and we build out more and more types of apps, including like the corporate formation app, the a more fulsome capitalization tracker, the more fulsome share sale app where you can actually do like a price share round wherein the convertibles would convert. As we build these things out piece by piece by piece, that will really unlock the benefits of all of this programmability and this trust reduction, this lowering of monitoring costs, this reduction of principal agent costs. It will get exponential, basically. That's why I call it CorpFi. You're putting corporate finance on chain in a really powerful way. So anyway, this is just a standard safe at this point, from here on out. And then the token warrant is the same thing, right? The token warrant's going to have its own NFT representing that. The token warrant is, quote unquote standard, A16Z token warrant stuff. I mean, I think you still see a lot of variation in token warrants and stuff. So I hesitate to really call anything standard. But A16Z's token warrant is a good one. It's a nice fair deal. I mean, that's what we're trying to do. And I also think like part of the benefit of a lot of having this app, having this set up is today, if you go to a lawyer and say, I want to raise a safe round, th depending on the lawyer, but a lot of them, they are going to draft up something for you that is extremely biased toward your interests, and I would say most likely to an unfair degree, right? And they won't use the market standard thing. They will use something that's better for you than the market standard thing. And then their expectation will be you will serve that up to investors. And hey, if the investors sign, great. You killed the investors. You screwed the investors. They were stupid and they signed this very biased document. But the more realistic expectation is that the investor comes back with their lawyer, they mark it up, they negotiate it, and then there's a negotiation process that happens, and then you end up somewhere in the middle at the end. I think that typical song and dance, and again, I mean, I've been a deal lawyer for 15 years. I think that typical song and dance is one of the biggest vampire attacks upon capitalism by, the priestly caste of so-called lawyers. I mean, it's not that they're evil, but it stems from a variety of things, including the way that they're regulated in the US, where you always have an obligation to quote unquote zealously advocate for your client and only your client's interest, right? You can't consider general principles of fairness or things like that, right? You're supposed to push and push and push and push and push for your client's selfish interest and screw the other guy. And that is how American lawyering is built and regulated. But I think generally it just results in a lot of wasted money and time and everything else. And a saying we have in the deal world is time kills deals, right? There's always the risk that you're an AI company, you're negotiating with some investor for 3 weeks over the terms of your safe, and in the second week, some new startup pops up that's doing the exact same thing as you, and they get more bullish on that, and they sign with them instead, right? Or something just very bearish with AI happens in general. Some company discovers AGI, and suddenly your business model doesn't make sense anymore. The investor gets bearish on you, and they ghost you, right? Time kills deals, and so especially with these early stage deals, you don't have a lot of money to pay lawyers yet, where there are reasonably fairly agreed market standards of what a fair deal is. Just cut to the chase, man. Just use the standard thing. The standard safe is a pretty fair deal for both sides. It's not really tipped heavily toward one side or another. There's really no need for you to be like negotiating this thing heavily. The A16Z token warrant, it's a pretty fair deal. I think there's a reflexive effect when you start to standardize some of these things and you say, hey, if you use the standard one, you have this really efficient process for using it. That in turn is kind of an extra motivation to indeed use the standard one. And that's, an extra, a loss of opportunity for people who want to complicate this process to in fact do so, right? Because, the better I can make this app, And the more some founder is going to be saying to their lawyer who wants to hem and haw and drag things out and customize things, why are we doing this, man? We can do this in 5 minutes on MetaLeX. You know, like how much better is the thing you're going to get me than the standardized deal that MetaLex is offering on their app, right? And are you really going to get me that, or are we going to like try for it, and then the investor is going to like laugh at us and get mad and change it and push for something that's even more beneficial to them? You know what I mean? It's just that's my vision here, right? I just think it's a vast majority of it is bullshit. And I say this as someone who's made a living off of doing this sort of thing. So anyway, again, just part of the philosophy, part of the law. And this token warrant is, I think, it's pretty fair. So yeah, so then we come to this left-hand side here, right? And this is where we're actually going to fill in the details of, of our specific terms of the agreement, right? Again, this is a template. To make it a deal, we got to have specific things in it, right? So the first thing I'm asked to pick is what network this is going to be on. We basically support Ethereum mainnet and currently two Ethereum L2s based in Arbitrum. They both work great. We also support testnet if you just want to try this out on testnet, right? But anyway, I'm going to choose for this Ethereum mainnet. And what are the trade-offs there? Well, you can use an L2 or you can use mainnet. L2s are obviously cheaper and faster. Mainnet is good because that is the one with the best trust assumptions, right? It's decentralized. And I would say part of the philosophy of the whole L2 scaling thing is you're really supposed to do asset issuance on mainnet and then have the ability to move assets onto different L2s, do things with them, etc. But you always could escape the asset back to Ethereum itself. So that is the philosophy of the L2 scaling. I think for securities, it does matter less because ultimately it's a centralized asset anyway, right? There could come a time where these things are really trading super liquid, and then, it might matter more. It might, a particular share might be more like a cash asset that you really want to make sure you can escape back to mainnet or something like that. You don't want to have to call up the startup that you invested in and ask them to void the certificate and reissue it or whatever, if an L2 rugged you, for example, right? So, it's a factor. It's something to think about where you want to park your money. But generally speaking, I think any of the options is fine for this. Where you really should do it is where you want to have the hub for your company ops, right? Because this money is going to go to most likely some multi-sig that you have, right, for your company. And you might want that on base, or you might not want that on base. If you're Kraken, you probably don't want your multi-sig on base because Coinbase controls it, right? So choose wisely. Anyway, and then you're going to set an expiry date. What is this? Well, you remember earlier I was talking about delayed sign and close. This is not really for delayed sign and close. In contracts, we talk about offers and acceptances, right? So when the startup finishes filling this out and signs it, that really constitutes an offer. It's not yet a completed contract. They're gonna send it to an investor, and that's going to be an offer that the investor can come and accept by themselves signing and paying the purchase price, right? And then there will be a contract, right? So this expiry date is basically like, how long are you going to keep the offer open? Because you might want to say to the investor, hey, sign this in 2 weeks, or you're not going to be my investor, right? Or you could make a custom date. You could tell them it's 2 days or 24 hours, whatever you want to do. But that's how long you're keeping the offer open before it goes away and it's no longer signable by the counterparty and they're out of luck. Then you got to fill in the details of your startup. So this assumes that you've gone and formed a company outside of our app. At some point, we'll offer forming a company in our app, but we don't currently have that. I'm sorry. I can only be so awesome for you right now. And I always like the Ridley Scott universe. So I always pay homage to Weyland Yutani from the evil corporation from Alien, or like, Tyrell Corporation from Blade Runner. You should make sure this is the real name of your company. Just FYI. And Delaware Corps are very, very cheap, by the way. I mean, and very quick. You go to Stripe Atlas, you could self-serve on that thing, right? So anyway, I will do Tyrell Corp here. What type of company is it? Well, it's a corporation, right? we got all kinds of options here. You could also fill in a couple custom option, BVI, super, say Panama, super anon, sketchy, foundation, right? I mean, do whatever you want. We call that the Fenwick special. But no, I mean, I do corporations. So contact, this is going to be sort of like the thing that is used for legal notices within the document. I mean, a lot of people prefer email. It's more formal, so to speak, especially for legal notices. Personally, me, I mean, I pretty much run my entire life on Telegram. I'm much more likely to notice something on Telegram, so I will give a Telegram. Why not? It's 2025, right? But this will be, if someone's going to sue you over this agreement, this is where they're sending it. So choose wisely. Startup payable address, this is going to be where the money from the investor goes. Jurisdiction of formation, you would like to make this accurate to where your corporation is incorporated. That means the law of the state where it's formed, where it's incorporated. It doesn't mean where you do business. It doesn't mean where you live. It doesn't mean where your office is. It doesn't mean where your quote unquote headquarters are. It means the state, the jurisdiction where the entity has legal existence, because every entity depends on a certain jurisdiction for having its existence, right? And Delaware, despite the FUD that you've heard, it's FUD. Delaware is a great jurisdiction. It is the no-brainer choice. Certainly, if you have an American entity, I mean, you should just almost always be picking Delaware, quite frankly. There can be exceptions, of course. Generally, hard to go wrong with Delaware. You're going to pick a dispute resolution method. These are the out-of-the-box ones we have, right? We try to make this pretty modular, right? So, like if you scroll to the cybersecurities purchase agreement here and you look at Exhibit B, these are the terms of the binding arbitration if that's the option that you pick. By the way, if you are in Delaware, probably a better choice is Delaware rapid arbitration procedures. I want to make this as generic as possible, right? So that we don't have 20 million versions of these documents on our web app. But that could be optimized, right? And I'll show you how in a second. And then there's the possibility of court adjudication, right? And if you're picking court adjudication, that's defaulting to your jurisdiction of formation. So if you want some other dispute resolution method, go write it up with your lawyers, go write it up with ChatGPT, go pluck a standard Delaware rapid arbitration provision off the web and plug it in here. Whatever you want to do, you can do that. You can put it in here, and then that will be your dispute resolution method rather than pre-configured options, right? I will go with binding arbitration because binding arbitration is pretty good. Officer details. These would be the details of the officer who is signing this document on behalf of the issuer. And, we'll say chief executive officer, right? By the way, make sure you have a chief executive officer because the default one under Delaware law is the only default ones, the only ones that are actually mentioned in the Delaware General Corporation Law are president, secretary, and I possibly treasurer. You can make up any kind of custom officer, but you would need to have that role in your bylaws of your corporation, and you would need to have appointed someone to that role in a resolution of the board of directors. Or sometimes that's done in the initial resolution by the incorporator. But again, I'm just giving you some corporate law trivia along the way here because I know some people appreciate that. This isn't essential to the app one way or the other. You can probably write president here, you're probably going to be fine, right? But I just note that I often see people not understanding how this works. By the way, what even is an officer? An officer is someone who has delegated authority from the board of directors of the corporation. Typically, if we're dealing with a Delaware corp, it could mean something else under some entities law, right? But basically, it's an agent of the corporation that can sign certain things, that has certain authorities, and so on, often delegated by a board of directors. So anyway, I'll say president here. Check your bylaws, do your things correctly. And then there's valuation cap. Basically, it's the valuation that the investor is investing at, bottom line. So, if they're investing $100,000 and the, valuation is $1 million, they bought 10% of your company. Okay. That's the bottom line. So, let's go ahead and say it's a million is small. I mean, no one's doing a $1 million valuation cap. Come on. Nobody's plebs here. So let's say the valuation cap is 5 million, and let's say, well, I'm actually gonna be putting in money here, although I'm just sending it to myself. So, you know, just for the sake of argument, I'm gonna say let's just say $5. Okay. I'm a really big spender. I'm gonna go with $5. Okay. Um, this here, that's gonna be the amount that I'm expecting the investor to invest. So when I send them the link for this, they must invest $5, right? We don't have something set up where there's some bidding process. We're working on it, but that's not currently. You have to know how much they want to invest, and you have to put that in. What you could do, one way to use the app, and I'll show you some other nuances of this, is you could just write up a bunch of tickets, right? Like you could just say, hey, I think some people are going to want to invest for 5,000 a piece. I'm just going to spin up a bunch of these offers, right? And them around to people who I think are interested in investing 5K, right? And I want 100K tickets. So I'm going to spin up a few of those, right? And then, if no one comes and uses them, okay, no one came and used them, right? They're just going to expire and that'll be fine, right? But you'll have them to be sending to people to try to close these deals and get your money fast, right? I mean, I probably would do that if I were raising around for a new company. You'll see here this is the IPFS link for the actual text of the safe agreement. But, you know, that's the agreement. That's the same one that's getting displayed here. All right. But you should take a look at it because that's going to be stored in your NFT and all this on-chain data and stuff, right? So you want to make sure it's correct. Then there is token warrant details because we're buying two securities in this scenario. We're buying the safe at a $5 million valuation for $5 all in. And then we're also doing the token warrant. Token warrants have, they're kind of a beast unto themselves, right? I mean, we could talk about why is it a warrant? What does a warrant mean? Well, a warrant means you're buying the right to buy something else. Sometimes it's shares of stock. In this case, it's tokens. You're buying the right to buy tokens later. Why would you do that? Why would you not just buy the tokens? Or why would you just not buy a right to tokens instead of buying a right to buy tokens? Well, it can play into certain tax strategies. I've had some lawyers argue to me that it's also a regulatory strategy, that if you buy a right to buy a token, then the token is more likely to be deemed as commodity rather than a security. I think that is not true, but I've heard it argued. So yeah, basically at the end of the day, most times people are doing this is because it's for a tax strategy. Although it also can be that you think your safe is worth $5, but you actually think your tokens, they should be bought at a later time, right? They should be bought for real money at a certain time, right? Like very typically, I would say these things are priced at a nugatory amount, right? Like you might have a per warrant exercise price, and I'll explain what that is, of like $500. And the $500, everyone knows it's buying you $5 million worth of tokens, right? And that's fine. The reason the exercise price is there is basically for a tax strategy, not because the company actually wants to make money from selling the tokens at that point. In the company's opinion, they're actually making money from this, right? This $5. And they're not worried about actually making money when the token is sold. But as in this scenario, $5 is not very much. It could be, no, I actually want to sell the tokens for money. I want to make money off selling tokens at a later step as well, right? And so in that case, you would set a meaningful exercise price. You'd say, hey, at minimum, you're valuing it at 5 cents a token or whatever. And if you want to buy the tokens, guess what? I want you to actually pay me that 5 cents when you decide to buy them, right? So there's all kinds of ways you can mix and match this stuff. But the typical scenario is where really almost all the money is being used to buy the safe. And you're really just getting a token warrant as a bonus for that. It's like you're double spending the money, right? To buy both equity and tokens. And so you're just going to put a nugatory per warrant exercise price of $100. That means when the time comes, the investor will pay you $100, and they're getting lots and lots of tokens for that. They're probably getting potentially millions of dollars of tokens or whatever, and they're only paying one. Then there is and again, all this stuff is explained fairly well in tooltips. If you're ever looking at one of the tooltips and you think, I read the tooltip and I still don't understand a thing, just DM me or at me on Twitter and tell me what you're confused about, and I will do my very best to make the tooltip more clear. Then there's a question of the token calculation method within the token wallet, right? It's going to determine how many tokens you may potentially buy under the token warrant. And there's essentially two methods there. Again, this is all relative to A16's use form, but I think it's a good one. It's prorated somehow to what your equity ownership is under the safe, right? So if it's equity prorated to company reserve, that means the company has agreed to set aside a certain percent of the token supply as the total percentage to be allocated among company employees, company investors, company officers, company vendors, everyone that all the entire quote unquote pre-mine, right? The company reserve is basically what we used to call a pre-mine before everything became totally VCified. That's what it is. And so if it's equity pro rata to company reserve, let's just say the total pre-mine, so to speak, is 30%, and you own 5% of the company under your safe. Let's just say it was 10%, because then the math is easier. You own 10% of the equity of the company. Company reserve is 30%. That means you're getting 3% of the token supply total. So that's how that one works. And the company can also agree, by the way, that the company reserve will be no less than some certain percentage of total supply. They could still give you more if they want, right? But if we plug in that 30%, then you as the investor will know, and let's just say you own 10%, you're buying 10% of the company here, the safe, you, the investor, will know that you will get 3% of token supply minimum. What I just said is not exactly guaranteed to be true, because it's possible that after the point that your safe converts, but before the TGE, the company does another financing round and dilutes your 10% down, and then it subsequently does the TGE, and then your calculation will be based on whatever your equity ownership would have been at the time of the TGE, right? So, there's some nuance there, but if you are an investor, I would recommend that you require a minimum company reserve if they're using the equity pro rata, the company reserve method. The other possibility is equity pro rata to token supply, right? And that would mean if you own 10% of the company, you're getting 10% of the token supply. However, there is the option for a multiplier. What does that mean? Well, it's very typical that the total supply of the tokens or the total protocol valuation or whatever you want to call it may be higher than the equity valuation of the company, which of course makes sense to a certain degree, because the people who own the company are only getting a portion of the network of the tokens, right? So logically speaking, if you think that the total value of the company is largely a function of this token that it's going to create, and the company is only getting half of the token, then that most likely means the network itself is worth twice as much as what you value the equity of the company at, right? And so if that is the type of reasoning that you're using, which is not uncommon in these deals, then you would put in a network premium multiplier under this method, right? You would say, oh, the network is worth twice as much as the company, right? What does that mean? Then when you would be calculating how many tokens you as an equity holder are entitled to buy under the token warrant, it actually becomes a divisor where basically you are dividing your equity by that, right? So if you owned 10% of the company, the method of calculation is equity pro rata to token supply, and there's a network premium multiplier of 2x. That means you're entitled to 5% of the token supply, right? So that's how you configure these things. There's many options. And if you go to Safety, for example, you're going to see that one has some additional options for token calculation, including just straight up dollar pro rata to protocol valuation, where basically you just take the dollar amount you used to buy the safe and you're just, basically dividing it by some valuation, right? So That's another way to do this, right? So it all depends on what instrument you're picking here, what token calculation methods are available. Because again, if it's an A16Z safe, I think we should stick to the A16Z parameters, right? So, I stick with their template, right? Because people know what the A16Z token warrant is, and I want them to have, like, relatively speaking, the standard one that they know, if that's what they think they're getting, right? So, there's many ways to slice the cat here. And if you want a custom deal again, we can do that as well, right? So anyway, let's say it's equity pro rata to token supply, and let's say it's a 2x multiplier, all right? So, and then there's the lockup, right? So there's a couple of levels to understanding of lockups. Number one is this is a Reg D compliance strategy. That's the option we picked. And you can always determine that if you look at the header of the actual security itself, it's a Reg D raise, right? So that means we're selling to accredited investors, and most likely include some US investors. Could also include foreign investors. Part of the rule of qualifying for that exemption is that the securities sold pursuant to that exemption are what's called restricted securities, which means that you can't just immediately go out and sell them freely. That transaction, that secondary sale, remember how I said all securities sales must be either registered or exempt? Well, that goes not just for issuances, like fundraisings like this one, it also goes for secondary transfers, like buy an investor to another investor, right? Those also need to be either registered or exempt, right? So to have an exemption for that, there are various exemptions available, but generally speaking, typically speaking, you you have to have held the security for at least a year before you could sell it forward, right? Now that's just under the securities laws themselves. There can be contractual transfer restrictions on top of that, and there usually are, right? And so that goes for the securities themselves, right? You're going to get a token representing your safe. You're going to get a token representing your token warrant. Those tokens have transfer restrictions. On top of that, and then largely speaking, those are just securities law plus, the issuer, you need the issuer's approval to sell, right? Generally speaking. So in our smart contracts, that means the issuer has to toggle on that you're allowed to transfer it. And we'll eventually build more and more sophisticated compliance tooling around that so that potentially can be more automated and you don't have to like totally trust the arbitrary discretion of the startup as to whether they let you sell and things like that. But that's for a future time. Secondary to that is the tokens that you're buying under the token warrant typically are going to have some contractual lockup provisions around them. And we all know this. Typically, like after a token sale, the early stage investors can't just immediately dump their tokens, right? They're going to unlock over time. So that's what this unlocking schedule, that's about. This is about that, about locking up the tokens that people are going to buy pursuant to the token warrant. And basically, we offer you, all kinds of options here as to what is the time interval over which you want tokens to unlock. Monthly, I would say, is a very common one, but daily is also common because people don't, in these lockups, if people are selling their tokens as they're unlocked, they like to avoid clumpy sales. They like to avoid big dumps. They like to smooth out the curve of the sales. And so if it's daily, smooth it out quite a bit, right? If it's hourly, smooth it out even more, right? Just all depends what you want to do. Let's say daily. And then when are you starting your unlocking period from? You could start it from the time that we closed this deal. You could start it from, I would say the most common is the token launch event, right? A very typical lockup provision is your tokens unlock over a 3-year period starting from the token generation event with a 1-year cliff, and we'll talk about the cliff in a second, where they're not actually unlocking at all, but it gets counted. Or you could just set some arbitrary time in the future where they start unlocking, whatever. We're going to do token launch event. That's the most normal one. We're going to do daily unlocking from the time of the token launch event. What would be the length of your unlocking period? Well, let's just say it's 1 year. I mean, but just easy to think about. And then let's say there's going to be a cliff. What a cliff means, now you can select whether you want to have a cliff or not. Some people don't want cliffs. Some people don't like cliffs. But a cliff is fairly typical because a lot of times during the first 6 months, during the first year, whatever it is, you actually don't want people selling their tokens at all. So technically it's unlocking, right? Like it's part of the unlocking period, but they're not actually going to get their tokens until the cliff is hit, right? So that could be 360 days. And then, you set a percent of how many well, let's just make it let's actually make it like 180 days here. So like the full period is a year, then half a year would be the cliff, let's say, right? And then it's a question of how much do you want to unlock at the cliff. Sometimes people don't lock any at the cliff. So in effect, it's kind of weird, but that ends up being, it's almost like there are multiple sub periods, right? And during it's all called an unlock, but really you're only unlocking during part of it. More typical, I would say, and frankly, more logical, is that at the end of the cliff, you get like a credit. You get a back credit, right? That's really what a cliff is supposed to be, right? So if it was 6 months and it's a 1 year total unlock, so 6 month cliff, 1 year total unlock, well, then you'll be getting 50% of your tokens at the cliff, right? Um, so these are you have to be careful to parameterize this the right way, right? And you could DM me, I'm around to help. You can have a lawyer, they could be around to help. Use ChatGPT, but think about it, do it correctly, the way that you want it, right? And by the way, if you don't make this the same for all your investors, they are probably going to get very mad at you. So you should probably also make it the same for all your investors. Um, as we build out the round functionality, I mean, that's why we have the round selection in the previous screen. We're going to start enforcing some of these things, right? Or like if you're not doing it the right way, we're going to surface that fact very prominently to investors, right? So like as an investor, you never want to have a different lockup period from other people in the same round. I mean, that's just unfair, right? So part of what we can offer here are ways that everyone knows they're getting a fair deal, right? And so, we're going to build it out so that within a given round, if you're trying to give someone else totally arbitrarily different a worse deal, that fact will be advertised to them, or you just won't be allowed to do it, right? Things like that. But right now, these are individual deals, so in theory, you could set different parameters. I would strongly recommend you not do that and that you keep a good relationship with your investors for whatever it's worth. And by the way, it goes on chains, they'll be able to see, right, what you give to someone else, right? So yeah. Offer type. So what this does is this allows you to make a decision of how you're going to run your round, right? So if you already know all the name of your investor, the address of your investor, like you already know that you're going to give this deal to a specific investor, and you basically already know that that specific investor is going to take this deal. They want to invest the $5. They agreed to this valuation cap, blah, 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 blah. Like this investor, you already hammered out the terms. You might as well get this information from them ahead of time, including, the blockchain address. The investor can also be an entity, right? It could be a corporation or whatever. Whatever it is, if you know the details in advance, you could fill this in, and then it's like, okay, when you send them the link, which we're going to see in a second, this is going to be very specifically tailored to them already, right? Other way you could go, of course, is you could say, hey, I'm talking to 20 different investors right now. I know quite a few of them are interested in a $5 ticket. I'm going to just send this link out to a bunch of them and first come, first serve, you know? So, and then if you do that, I recommend you password gate it because I mean, unless you truly just want any schmo to be able to come and buy your security, um, uh, don't recommend that. I mean, you could do it. And reason why you could do it would be if you're doing what's called a 506C round, and we offer a solution for that. So basically if they're like really verified to be accredited, right? Like they have $1 million of net worth on chain. They could have signed up to get a certificate from us that attests to that fact. And then you could check, hey, don't let them invest unless they have that certificate. And that basically lets you do what's called a 506C round, where you're more publicly soliciting interest in this offer, right? Um, I would probably need to do an entire other video about that, but that's what this is. If you understood what I just said, great. If you didn't, don't really worry about it. It doesn't really matter to you. Okay, and then you could password gate that, so that in theory you could start send this link around to 5 people, and whoever takes it first takes it. You know what I mean? You could also spawn off a bunch of these at different ticket sizes, password gate them, and send them around to people that you want to invest. And again, first come, first serve, whatever, and you have a bunch of them, whatever you want to do. There's many ways to do this. I mean, I would have loved to have something like this when I was initially raising for MetaLeX, right? I think it could have been super useful. And I probably would have gotten more different kinds of people to invest earlier because it just would have been way easier to like send these links around and stuff. And it would have been cool. It would have been useful. Anyway, I'm going to make this closed round for simplicity. And I'm just going to say, who's investing? What's the name of the replicant in Blade Runner? I'm losing my mind. I'll just say Bishop, the android from Alien. We're trying to keep this to the Ridley Scott universe. And I'm going to fill in my other address here, which is where will I be investing from? Yeah. And so I already know my investor's address. I know he's Bishop at on let's say Bishop at we got Tyrell Corp, we'll do Wayland Corp and actually, what, we'll make Wayland Corp the investor and it's Bishop at Wayland Corp is the contact and we'll say it's a corporation, right? And we'll say it's a Delaware corporation. Okay, yay. So now we have all this set up, right? We have the deal parameterized. And what I'm going to do is and I'm going to open up my ledger and I'm going to sign the deal on the company side, right? Right now, I'm in the role of the issuer's officer, right? And this is warning you not to use a centralized exchange address. It's confirming, hey, this is the person that's going to invest in me. This is their address. That's a pretty key detail if you want to gate this. If you put in the wrong address, you're going to be selling your security to the wrong person. That would not be good. You can see we've got, you can scroll through here. You can see what your parameters are. I mean, I recommend you double check them, right? And if you're using a ledger like this, you're going to see it on here as well. And you can flip through. You're going to see lots of details about the smart contract on here. If you care to review them here, purchase amount, exercise price, all that good stuff. You can double check it here on your ledger if you have one of these, right? I'm going to skip all that because I trust the app and I'm going to sign. And now I, Tyrell Wellick, I have signed the deal. And now I create the deal. So the sign is really, it's like a legal signature. When I create the deal, I'm also configuring the escrow and I'm deploying a contract that represents my entity and doing a bunch of stuff that basically sets my company up to be able to issue tokenized securities and manage these deals on chain, right? So now I'm basically deploying smart contracts in this step. That's really what's happening. And boom. And so now I've done that. So it's going to process a bit and boom. Now the deal is successfully created. So as it's saying here, send this link. Boom. Right. So you can copy this link and now I can share this link with the investor. Right. It's saying shared because I copied it. Right. If the investor is using a multi-sig, if that address that you plugged in is a multi-sig, well, what you will want to do is you will want to go send them to this app and you will want to have them do a delegation, right? So basically the multi this will guide you through your multi-sig delegating to a certain EOA that the EOA can come and sign the deal. The reason why we do it like that is well, not in this case, but in a lot of cases, certain details about the investor will have been left blank. The issuer wants the investor to fill in their address or whatever. And it's just very cumbersome if a multi-sig needs to sign off on all those little details, right? Really, all the multi-sig has to do is send the money, right? So it's better to delegate to an externally to a single signature account the authority to sign the deal on behalf of the multi-sig. And then, the final step would be for the multi-sig to actually send the money. So this is a way to do that. I'm not going to walk through it all, but just know that it exists for investors who run their stuff through multi-sigs. And so now I can go here and I'll change addresses. So now I'll change my address to, let me disconnect. I'm going to connect here. And boom, it says I've been offered a deal. It says what the deal is. It's a safe and a token. It's telling you this is a legally binding investment. You are going to get 2 NFT certificates. These are going to be the deal terms, right? And you click the happy face. And in this case, because the issuer had all my information in advance, there's nothing for me to fill out. But if they had chosen one of the more flexible offers, then I would be coming here and I'd be filling out certain information about myself as an investor, right? Jurisdiction, the name of my entity, whatever that stuff is, right? And this has all the information you would want, guys. And what I really like about this is that, as an investor, typically you're just served up what appears on the right side of the screen. So you got to flip through, the safe, and you got to see what is the valuation cap, what is the purchase price. You got to redline it against the standard safe and see if there are any differences and all this sort of thing. With this, you don't have to hunt for anything. That's what I like about it. You can go look at this left-hand panel, and it really has all of the salient particularities specific to this deal, such as the amount you're paying, the valuation, the unlocking schedule for the tokens under the warrant, the method of calculation. It's all here. It's all the stuff you want to know is really broken down in just a much more visible, readily apparent way, right? And if it's listed here, that means it's on chain. And when you buy the NFT, that all this data is going to be embedded in the NFT, right? And so because it's through us, through MetaLeX, that there hasn't been anything weird inserted here, right? At least if you went through the custom flow, then it could be anything. You need to be more vigilant. But if it's one of our standardized deals, which you're going to be able to tell by looking at the label here and going to an IPFS link here, right? If it's one of our standard deals, this is redlined against the standard safe, right? So you're going to be able to tell what it is, and you're going to know if it's from us through our standard flow, it's a standard deal, right? There isn't some lawyer who tried to sneak in some super horrific provision that's good for one side. Our customers are both sides. We have no interest in screwing over one particular side of this, right? So that's another benefit to all of this, in my opinion. So now I have the investor view. I've clicked through the link that the startup founder sent me. All my information was already put in there by the thing. Otherwise, I would fill out that information, like my jurisdiction and so forth. Okay, so now I'm here. I'm the investor. I've clicked through the link to the deal given to me by the founder. The founder already knew all my information. I had given that to him previously outside of the app, so it's already all pre-filled out, right? And all I have to do at this point is sign, right? I just have to check these deal terms, and I just need to sign. So I'll go ahead and do that. Approve USDC. Transaction is taking a very long time. Okay, USDC is now approved, and now boom, the deal has been finalized. Okay, so you basically sign. You can't close the deal without funding, right? So that's one of the nice things about this, right? Because in my experience, again, 15 years as a deal lawyer, and you don't even need my experience. Go look at the Rick Burton Uniswap lawsuit. Go look at other lawsuits that have occurred. The Curve lawsuit, where basically investors signed something, but they didn't send the money, or they sent the money and they didn't sign something. None of that is possible with this, right? You cannot sign the deal without sending the money, right? When you send the money, that's when you get your certificate, and that's when the deal is closed, right? And so if I go look at Etherscan for this address, I am going to see that 1 minute ago I got 2 NFTs, right? From the Tyrell Corporation, the thing I invested in, right? One of these is going to represent the safe. One of these is going to represent the token warrant, right? This one here is this is the token warrant. You can see, look, it's labeled series pre-seed, right? Because remember, at an earlier step, I selected that pre-seed round, right? So anyone who looks at this NFT on chain, they're going to know this represents a token warrant from the pre-seed round of the Tyrell Corporation, right? That's very useful information. What else are they going to? Well, they're going to know the investment amount. So if I go back to our web app and I now go to my investments, I'm going to see all about this investment, and that's what it is, right? So that's basically it. So now you have this, and potentially you could trade this, you could lend against this, you could do all kinds of things with this. And later we will program it so that it actually converts into shares, when the company does. That is the our fundraising app in its current form in a nutshell. What we want to do in the future is, well, we want to accommodate the entire life cycle. We want to accommodate later forms of grants. We want to accommodate convertibility. We want to accommodate trading. We want to accommodate lending off of securities. We want to do all these things. So that's all in the future, should you continue to support us. And I think, again, I kind of call this CorpFi right now. It's cybernetic methods of automating corporate finance deal flows, right? On chain, mostly on chain. We'll weave AI into this at some point. That's why I use the broader cyber term rather than just saying crypto or on chain, smart or something like that. But yeah, that's what it is. So use us. I'm available to you. DM me. I mean, man, just the fact that I make myself available to this and I normally would bill, 4 figures an hour, I think kind of makes it a pretty good deal. But we'd love for you to use it and give us feedback and grow with MetaLeX over time. Thank you guys.